I mean, we hardly see this kind of chaos in the bond market. So can you explain what's triggered it and also maybe what investors are thinking? Because typically, one assumes that when you have an event like the collapse of SVB, that's a risk-off event and people move right into bonds. But it feels like something more is going on here.
Yeah, so it's an excellent point. I first of all say don't let your kids grow up to be bond managers. It used to be a boring job, but not anymore. Not with the recent events. So we have this still the Fed fighting a double mandate here, where they're trying to regulate inflation, and then we have this run on the bank, if you like, that causes a lot of uncertainty, and that uncertainty is increased volatility as people don't know necessarily what the next move is going to be, and will the Fed be forced to lower rates, increase rates, other measures or policies be put in application. So we've seen a high increase in volatility. I have not seen such big moves in the marketplace maybe since 2008. We've had 60 basis points moves in a days back to back in 2-year treasuries. That's something that's not supposed to move like that. Usually 25 is already a big move, and we've had 60 basis point moves. So the volatility has quite been present in the marketplace.
Yeah, let's talk about the volatility because a lot of people pay attention to the VIX index, which is for viewers, it measures the volatility of the stock market, and it's also known as the fear gauge. You look at what's called the MOVE index, which measures the treasury rate volatility, and we have a chart. So what's this showing?
So it's indicating that there's a lot of uncertainty in the marketplace. The volatility has skyrocketed back to levels that we'll say 2008. So this is something that while the VIX has been, I would say, moderate in its volatility or its level, it's not been the same thing for the bond market. It's really a reflection of the next meeting. There's people that are thinking a rate cut by the Fed. Some people are thinking a rate hike. Some people are thinking that there's going to be extra policy measures put into place. So this is actually leading to uncertainty, and that uncertainty leads to this increase in volatility, which is quite significant. And it's making your humble bond market a different place to invest at the beginning of this year.
Hmm. And then what does this mean for liquidity? I know you have a chart there as well, and we'll bring that up. What is this telling us?
So basically, when you have uncertainty, when you have, we always have a little bit of price uncertainty in the marketplace. That's normal.
Yeah.
That's why you have buyers and sellers. But when you have this extreme bout of volatility, the liquidity in the secondary market starts to dry up. People start to trade a little bit more agency in the marketplace. This is, the bond market is an over-the-counter market. It's not traded on listed exchanges. So, people are shying away maybe for some certain types of trades. And this is a good example from JP Morgan and Broker Tech that show that we're at levels we haven't seen since the March 20 COVID crisis and from 2008. So this is also making trading a little bit more difficult. And for portfolio managers, it means we have to really weigh in on how we move our portfolios. We have to find the right dance partners, if you like, in terms of moving our portfolios in terms of the risk.
So, Dominic, we have a minute to commercial break. Do you think this fear has been overdone? And do you think we'll see calmer markets pretty soon?
I believe that this particular case is overdone because of the fast reaction by the Federal Reserve and the regulatory bodies in the US. But
Hmm.
unfortunately, in this era of information and instant information and access to your bank account no longer at the teller, but really through your phone, that's going to continue having some volatility in the banking sector whenever there's a rumor circulating. I don't know how the regulatory or the Fed is going to address that particular issue.
So, is this more? Do we need stability in the financial markets? Do you think, or do you think we need a better communication from the Fed to calm things
I
down?
think, yeah, we'll find out in the following months what actually happened because, they're doing their investigation right now and we'll get an idea of the books. But if you look at what they were invested in, this particular bank on the West Coast, they were in treasuries and it's a mark to market issue and a classic run of the bank. One of our equity analysts, portfolio managers, I should say, Danesh was mentioning, in the 50 years ago, you would just tell the tellers to count the money slower and slow down this fear factor.